Hi, it's Anthony Fletcher. Thanks for coming to my channel, A Lender's Point of View. Today we're going to cover FHA loans and why you should rethink of this type of loan to be your next mortgage for your next house, especially if you're not able to put 20% down. Okay, so let's talk about FHA. FHA stands for Federal Housing Administration. It started back in 1934 after the Great Depression. And basically what there were over 2 million construction workers that were out of work. So Congress got together, created this particular program, and ever since it's helped millions of people get into houses that normally wouldn't have been able to get into. And of course, it's employed many, many millions of people and helped spur on the economy. So FHA was given a great program for such a long time. And then just real recently in the past, 7, 8 years ago, they raised the cost of some of the items for FHA, which made it more undesirable. But now it's gotten better. So let's talk about 5 reasons you should think about getting an FHA loan. The number one reason is 3.5% down. So that means if you're buying a house on $100,000, you only have to put $3,500. That money can be, believe it or not, that money can actually be borrowed from your family member. It could be a gift from a family member. So, and you only have to have a credit score of 580. Now, some mortgage companies out there or lenders out there, big banks or whatever, they may only have the minimum score for them go down as low as 640. So you might have to do some investigation and find a specific lender that might suit your needs. But in addition to that, there are also government grants and bond programs that are available that can give you that 3.5%. So basically, you should be able to find a loan out there with 0% out of pocket if you really can look hard and put together the right purchase agreement. Okay, if you don't have that great credit score, if you have a credit score between 500 and 579 and you do have money to put down, 10% down, you can still get an FHA program where you can't do that on conventional loans. 2, properties. FHA will allow you to finance single-family primary residences, including condos, manufactured homes, duplexes, triplexes, and fourplexes. And these duplexes, triplexes, and fourplexes, that's where the money is. If you are looking about buying your first home and you may not have enough income, these are tremendous ways to go because the rental units, you still need to live in one of the units. And if you don't mind having neighbors, the income coming in from the rental units can usually be used to help you qualify for your mortgage. So in a lot of cases, like especially with the fourplexes, the income that you get from this may actually pay the mortgage payment and you live basically free. Debt to income. So that's your total debts versus your total income. Now, with FHA, you generally have a front-end ratio, which is just your housing payment, principal, insurance, taxes, interest, and homeowners insurance and mortgage insurance. Okay, that's normally 36% of your total income. And that back-end ratio is normally 42%. Well, if you have specific, maybe higher income coming in, great credit scores, higher disposable income, you may get an approved response from the decision engine when the underwriter reviews your loan and actually go up to all the way to 57% back end ratio. So realistically, it may allow you to purchase a lot more house here. Now, another part, mortgage insurance, number 4. Now, this has been a change and it's a little hard for us to understand, but FHA charges mortgage insurance. Mortgage insurance is simply default insurance that you have to pay to the bank takes it out, you have to pay it, and basically it's default insurance in case you don't make your payments and the bank has to foreclose, they can get their money back. So you pay a 1.75% upfront fee. So if you borrow $100,000, you pay $1,750, and that just gets financed into it. So, and that only adds like $8 to $10 per $100,000. And then this is the monthly mortgage insurance has dropped from 85 basis points, so they've been $850 a year from for every $100,000 you borrow, down to $550 a year. So that's a savings of about 40%, and it's huge when you're looking about buying this house, because the thing about FHA, you generally get a much better rate if you have a lower credit score going FHA than if you go conventional. And so, and the mortgage insurance can be much lower on FHA than if you have a lower credit score and if you go conventional. So overall, FHA can severely win out when you're looking at buying a new house. And if you don't have the best credit score, or you don't have a whole bunch of money to put down on the house. Okay, finally, 5, appraisals with FHA. They're a little bit different than regular conventional appraisals. Conventional appraisals are basically the appraiser going in there and valuating the property for the bank. Now, for FHA, they go in and value the property for the bank, but they also do inspection on the property for the bank. And so they check up on the roof, they look up the roof, they also go up and look into the attic, and they will go also and look into the crawl space to make sure that, just for an added safety and security, to make sure that property is in good, secure working order. You still want to have your own inspector go out to the property, but this is a great kind of secondary safety net for you and the bank. Okay, so that covers 5 wonderful characteristics today, and I'm glad you are here to see this. Now, if you do have any questions, there is a number, 1-800-CALL-FHA. Call that number and you can get answers to your FHA questions. Also, talk to your lender, and talk to your lender early, so that if you talk to them 3 to 4 months in advance, you can get information and get your credit put together and get all your package together so that you're in the best situation possible to get the best rate, the best program, and the lowest amount of closing costs for your particular mortgage. Thank you for coming to my channel. I sure appreciate it, coming to a lender's point of view, and we'll see you again another day. Bye.